have it. The closing bell at the New York Stock Exchange signaling the end of another trading day on Wall Street. A big day for the Dow. The index climbed up over 530 points.
The S&P also saw some big gains, jumping about 2 percentage points, while the Nasdaq rose by almost 3%. Of course, investors are reacting to the July Consumer Price Index, which showed the annual rate of inflation at 8.5%, down from 9.1% in June. For more on this, let's bring in Ben Winck. He is a markets and economy reporter for Insider. Ben, welcome. So the CPI report was better than some economists predicted. What's your reaction, and do you think we've reached a point where overall inflation will start to gradually decline?
Well, first off, thanks for having me on. My initial reaction was really that this is encouraging in every which way you could read it. We saw that year-over-year headline inflation did hit 8.5%. That's down pretty substantially and more than economists had expected. But it's also some smaller details in the report. We saw core inflation, so that's what doesn't include gas and food prices because those are fairly volatile. That also dropped at least just through July. On a year-over-year basis, it was still steady, but seeing that also improve was very promising. And then to also see that headline inflation through July alone was flat. We didn't see prices broadly increase. Again, just a lot of really positive signals, and you see that in what's going on in financial markets. I think this could be the start of a longer cool down. I think it is a bit too early to say, oh, this is the peak. We've been there in this pandemic. We've said before, this might be peak inflation, and then it just kind of rebounds and goes even higher. So I'm going to hold out for maybe a couple more months of data, but this is very promising across the board, better than what economists expected. And we've seen gas prices and some other commodity prices continue to fall through August. So there is a pretty good shot that we see the August inflation reports show another cool down.
Okay, so to your point, Ben, that the CPI report is essentially good news. What do you say about the fact that prices are still high, particularly the cost of food and housing, and it's just still a burden for a lot of Americans? So do you see a disconnect between the sort of optimism on Wall Street and the realities that a lot of Americans are still facing at the grocery store?
Absolutely. It's a great point because I think, yes, we can cheer this report all we want, but at the end of the day, inflation is still near 40-year highs and prices are still way above what they were a year ago. So yes, on the ground level, it's still extremely, it's much more expensive than things were even just a few months ago. And so that's factoring into financial planning, that's factoring into what people are able to go buy and maybe how much they're driving. Gas prices have fallen a lot, but they're still not at the lows that we had a year ago. So yes, prices are still very high, and there's a long way to go before we get to inflation that is stable and more sustainable for us to have a healthy economy. But I think a lot of the enthusiasm you see today around it, and for me as well, around this inflation report in markets, is that this is a sign that things are on the mend, or at least look to be on the mend. And at this point, after so many months of the highest inflation we've seen since the 80s, any sign that we are kind of turning a corner, turning the page on that, and getting to a healthier, lower inflation rate, and that's going to be cheered pretty loudly on Wall Street and within economic circles.
So another question, though, Ben, how do you think these inflation numbers are going to play into the Fed's upcoming decision on raising interest rates?
We've already seen in markets, at least after today's inflation report, that they're kind of leaning more toward a half-point rate hike, similar to the one we saw in May. Down from the past, we had 2 3/4-point hikes at the June and July meetings. So, that I think there's a lot more time before we see, what the Fed's going to do next. The next meeting is in September. So, we still have some jobs data, some more inflation data that we're going to get. But I think that a 50-point hike or a 50 basis point hike or a half percentage point hike, I think that's a pretty safe bet. We've seen gas prices continue to fall. There's some signs that just in general, the supply side is improving as well. So if that continues, if we don't see any of those kind of rebound and cause some more concern, I think a half-point hike does make a lot of sense, especially because we're already kind of getting into those restrictive interest rate levels. And the Fed is going to be very cognizant of not wanting to overdo it, because then you risk really harming the labor market's recovery. And that's still clearly holding strong, but you want to let that keep going because there's still, yes, we're at record employment, but there's still so much employment we have to make up from these 2 years of the pandemic and the recession.
Right, so many factors to consider. Ben Winck, Ben, thank you very much.
Thanks for having me.